Welcome, everyone. Thank you for joining us. My name is Joe Bloodgood, and with me today is my partner, Nathan Faith. We're going to be talking today about health insurance and the Affordable Care Act. One of the most frequent conversations we have with clients as they approach retirement is about how health insurance will be funded. A common situation is where we have a client that is well on the road to retirement. Their financial situation is in order and on track to meet and exceed their goals. But there's one missing element. They, for example, would like to retire at age 60 or at age 62. They know that they can't join Medicare until they turn 65. And there's the no man's land called the health insurance gap, where they're essentially on their own. So today we want to talk a little bit about how you fill that hole or plug that gap and what some of your options may be. Nathan, talk to us a little bit about some of the questions you see on this front.
Yeah, thanks, Joe. So the biggest question that we receive from clients is, how much does health insurance cost from the time I retire until I can enroll in Medicare at age 65? And for a married couple, that cost typically comes in at about $20,000 a year. So their options oftentimes are, can I continue my coverage through work under COBRA? Can I go outside into, say, the marketplace, work with an agent and get my own health insurance? Or can I go on, say, a marketplace with the government called Obamacare and get insurance? Regardless of which option you choose, the insurance company is going to charge about $20,000. Now, that's a scary proposition. Many folks say, I'd rather just continue working in order to keep that benefit going. But what if that cost wasn't entirely on your shoulders? Because it isn't always all your out-of-pocket costs. Sometimes it can be shared or subsidized, not by your employer, but by Uncle Sam. And with a little planning, your out-of-pocket health insurance costs can be reduced from, say, $20,000 a year if you're married to a fraction of that amount. And where this comes into play is with Obamacare. So very few folks really know how Obamacare works, but what Obamacare was meant to do was provide affordable health insurance coverage based off of your income. Now notice that I say income, not your wealth. We have clients who have qualified for very low health insurance costs that may have millions of dollars of wealth, so dollars within their homes or within their nest egg, but can keep their income quite low. Obamacare is means tested, and the means that Uncle Sam looks at is the income that shows up on your tax return. And from there, the government identifies how much health insurance you are deemed to be required to pay for, and the rest is then subsidized or paid for by Uncle Sam. So up on the screen is the actual calculation that the government uses for identifying how much of your health insurance premium are you required to pay based off of your income. And the government uses certain thresholds called the poverty line. So the lowest threshold for a married couple is the poverty line, which is set at about $17,000. Notice if your income is below $17,000, a married couple is actually on the hook to pay for all of their health insurance costs. That seems totally backwards. If you have little income, we would anticipate that the government would pay all of our health insurance costs. But there's a glitch in Obamacare in which the government assumes that you have no wealth whatsoever and therefore would qualify for Medicaid, which then would cover all of your health insurance costs. But Medicaid requires that you have less than really $3,000 to your name. What if you have more than that? You actually want to ensure that your income's above this first line. And then for each bracket, which is doubling the poverty line from $17,000 to $34,000, and then again to 51,000, again to 67,000. You can reference how your level of income dictates the share of your health insurance premium that you're required to pay for the year. And the difference between your premium, say $20,000, and your share is what the government is going to pay for through a tax credit. Notice how, as your income increases from 1 times the poverty line to 2 times, your health insurance premium goes up by about $2,000. And then again, as you move into the third bracket, and again, as you move into that fourth and final bracket. But the key point is, even at that orange bracket where your income is 4 times the poverty line, your share of the health insurance premium itself is about a third, and the government pays for the other 2/3 of your health insurance premiums. But above that line, if your income goes over that line by just $1, you are then deemed to be able to afford all of your health insurance premiums, regardless of what that cost actually is. And that's why it's so important to know where you stand income wise so that you can manage your health insurance costs.